Who really controls money? Governments? Banks? Or institutions most people never see? Behind the global financial system stands a quiet power: central banks. For centuries, money appeared simple. Coins, banknotes, numbers in an account. Yet behind this apparent simplicity lies a complex system, one that determines the value of almost everything around us. At the center of that system stand institutions that rarely appear in public conversations, yet their decisions influence prices, wages, credit, and even the stability of entire economies. These institutions are central banks. Today, nearly every modern economy has one. Their purpose seems straightforward: to maintain stability in the monetary system. But the way they do this is far more complex. Central banks manage the supply of money within an economy. They influence interest rates, monitor inflation, and often act as the final line of defense when financial systems come under pressure. When economic growth slows, they can make borrowing cheaper by lowering interest rates. When inflation rises too quickly, they can do the opposite, making credit more expensive in order to slow the economy down. These decisions may sound technical, but their effects reach far beyond financial markets. Higher interest rates can slow businesses and investment. Lower interest rates can encourage borrowing and expansion. In other words, central banks influence not only banks and financial institutions, but the everyday lives of millions of people. Yet an important question remains. Where does this power come from? The origins of central banking lie in times of financial instability. In the past, governments struggled with unstable currencies, banking panics, and growing national debts. To restore order, new institutions were created, banks designed to stand above the rest of the financial system. Banks that could regulate credit, provide emergency liquidity, and act as guardians of the monetary system. Over time, these institutions evolved into what we now know as central banks. Their role became even more important after the global financial system moved away from the gold standard. In the era of gold-backed money, currencies were tied to a physical resource. But once that link disappeared, the value of money began to rely less on gold, and more on trust. Trust in institutions. Trust in governments. And trust in the stability of the financial system itself. This transformation placed central banks at the very core of modern economies. Yet it also raises new questions. How much influence should these institutions have? Who ultimately holds them accountable? And how stable is a financial system that depends so heavily on a small number of powerful institutions? Central banks often operate quietly, far from public attention. But their decisions can reshape the economic landscape of entire nations. Interest rates change. Markets react. Currencies move. And the effects ripple through businesses, governments, and households alike. In a world where money is no longer tied to gold or silver, the stability of the system depends on something less tangible: confidence. Because at the foundation of the modern financial system lies not only economics, but belief. And central banks have become the institutions entrusted with maintaining that belief.